But here's the question every investor should be asking: which companies are positioned to turn these global spectacles into serious profits? I'm your friend, and today we are diving deep into two American giants that have been World Cup sponsor for decades: Coca-Cola and Visa. By the end of this video, you will understand exactly how major sporting events impact stock prices, what happened during past World Cups, and whether 2026 could be different. Let's follow the money. The 2026 World Cup isn't just another tournament. It's the first World Cup generated over $7.5 billion in revenue from FIFA alone. But here's what matters for investors. This isn't just about FIFA's bottom line. We are talking about a massive economic ripple effect. Tourism spending, advertisement splits, merchandise sales, and payment processing fees that flow directly to companies like Coca-Cola and Visa. So the big question is, does this translate to stock price gains? Let's find out. Price. Now you might think that's a lot of money. Surely their stock must spike during the World Cup, right? Well, not. In 2014 in Brazil. But that was in line with broader market trends. Here's the reality. Coca-Cola is a $270 billion company. Even a massive spike in beverage sales during the World Cup represent a tiny fraction of their annual revenue. We are talking about maybe a 1 to 2% bump in quarterly sales at best. June 2021, during the European Championship, Cristiano Ronaldo sits down for a press conference. Two Coca-Cola bottles are in front of him. He looks annoyed, moves them out of frame, hold up a bottle of water and say,
Coca-Cola.
The headline was explosive. Ronaldo's snub cost Coca-Cola $4 billion. The story went viral worldwide. Coca-Cola's share price dropped to 1.6%, and the market value fell from $242 billion to $238 billion. But here's what actually happened, and this is critical lesson for investors. The stock had already started falling before Ronaldo's press conference even began. June 14th was also the ex-dividend date for Coca-Cola, meaning the stock naturally adjusts downward when dividends are paid out. Plus, the broader market was down that day. After Ronaldo removed the bottle at 9:43 a.m. New York time, Coca-Cola's stock actually rose for the rest of the trading day, from $55.27 to $55.55. And by the way, the next day, Paul Pagova removed a Heineken bottle from his press conference. Manuel Locatelli did something similar. UEFA sponsors were having a rough week. Studies show that major sporting event sponsorship can increase brand value by 2 to 7% over several years. For Coca-Cola, that brand equity is worth billion, even if it doesn't show up immediately in the stock prices. So what about 2026? Here are three factors to consider. First, the North American market is Coca-Cola's largest, representing about 40% of their volume. Home field advantage could mean stronger promotional opportunities. Second, the expanded 48-team format means 60% more matches and longer tournament duration, potentially extending consumer engagement. And third, Coca-Cola has been diversifying beyond soda into sports drink, energy drinks, and water. World Cup marketing could boost these higher margin products. Now let's talk about Visa. And this is where things get really interesting. Visa has been the exclusive payment service sponsor of FIFA since 2007. But unlike Coca-Cola, Visa has a direct, measurable path to revenue during major events. Here's how it works. Every time someone uses a Visa card to buy tickets, merchandise, hotel rooms, flights, meal, or anything else related to the World Cup, Visa collects a small transaction fee, usually around 1.5% to 3% of each transactions. During the 2018 World Cup in Russia, Visa processed over 2.5 million transactions at tournament venue alone. That doesn't even count the millions of transactions for travel, accommodation, and related spending. The 2014 Brazil World Cup generated similar results. Visa stock actually performed better than the broader market during both tournaments. So, what's the advantage? For 2026, Visa has several unique advantages. First, North America has the highest card penetration and digital payment adoption in the world. Second, FIFA has made all 2026 World Cup venues cashless, meaning every single transaction goes through digital payment networks. Guess who dominates that space? Of course, Visa. And last, the 48 team expansion means 60% more matches and potentially 40 to 50% more international visitors, each making multiple card transactions. Let's get practical. If you want to actually invest in these companies, here's exactly how to do it and what strategy makes sense. How to invest. Both Coca-Cola and Visa are publicly traded on New York Stock Exchange. You can buy them through any brokerage account like Fidelity, Charles Schwab, Robinhood, E-Trade, whatever platform you use. There are investment approaches. So for Coca-Cola, there is current price around $63 to $65 per share and their dividend yield approximately 3%. And this is best for conservative investors wanting steady dividends and brand stability. For Visa, their current price around $290 to $310 per share. So what's the strategy? Dollar cost averaging. Invest a fixed amount monthly to smooth out price fluctuations. So best for growth-focused investors betting on cashless economic trends. Second approach, event-driven trade. So what's the timeline? There is an entry point, 9 to 12 months before the tournament, first quarter to second quarter 2025, and whole period is through the World Cup, June, July 2026, and exit strategy 2 to 4 weeks after the tournament end. Here is the positioning size. Only use 5 to 10% of your portfolio for event-driven trades. Consider buying both 60% Visa, 40% Coca-Cola. Because Visa has stronger World Cup correlation. Set a stop loss at 8 to 10% below your entry to limit downside. Take partial profits if either stock gains 15 to 20%. This is the allocation. Conservative investors 70% Coca-Cola, 30% Visa. Balanced investors 50-50 you can split. But growth investor 30% Coca-Cola, 70% Visa. Bottom line. The 2020 but smart investing is about understanding the mechanics behind the headlines. Coca-Cola offers stability and dividends with World Cup brand reinforcement as a bonus. Visa offers growth and direct tournament revenue with measurable impact. Whether you are buying one share or building a larger position, the key is having a plan. Know your entry point, your timeline, and your exit strategy. If you found this helpful, smash that like button and subscribe for more practical investing content. Thanks for watching and remember, invest smart, not on hype.